So let's talk about GDP. GDP stands for Gross Domestic Product. A more complicated way to say that is it's a way to measure domestic output and national income. So depending on what version of the textbook that you've had, this might be chapter 25 in your textbook, or you might have to look in the index for GDP to see where it's covered in the pages of your book. But I'm going to go through a few of the main ideas to help make it make sense. So first of all, when we talk about measuring domestic output, we have to talk about something called national income accounting. This is generally performed by the Bureau of Economic Analysis, and it measures the country or the economy's overall performance. So the Bureau of Economic Analysis is looking at things from month to month, from quarter to quarter, from year to year. And so this is one branch of accounting that you might choose to go into if you were choosing an accounting career. Again, it's looking at the economy overall as a whole. It's performed by the BEA, Bureau of Economic Analysis. So then gross domestic product is simply the total dollar value of all final goods and services produced within a country's borders in a year. Another way to say total would be aggregate. So when we talk about aggregate demand and aggregate supply, this is related to gross domestic product. A couple important things to keep in mind when we say final goods and services. This implies that intermediate goods are ignored. So if you have a company that makes a product that then is used to make something else, we add value at each stage of production. We don't look at the value of the intermediate good as well as the value of the final good, only the value of the final good. So there's a couple different ways that GDP can be figured. One is called the expenditures approach, and this is the most statistically accurate version. It's the most used version, but you can also technically look at the income approach as well. So on the left-hand side of the screen, you have 4 categories that are added together to equal GDP. On the right-hand side of the screen, you have 5 categories that are added together to calculate GDP. Notice that on the left with the expenditures approach, we're simply looking at categories of spending. On the right, we're looking at categories of income, plus we have to look at something called statistical adjustments. So when we add all these things up and they don't equal the number we found in the expenditure approach, we create a statistical adjustment, or I should say national income accountants create a statistical adjustment to compensate for that discrepancy. This is why I say the expenditures approach is more statistically accurate. So we're going to spend the most time on the expenditures approach because it's the most often used way to calculate GDP. So the first category is called personal consumption expenditures. This is abbreviated as C in a formula that I'll show you here in just a minute. Personal consumption expenditures include durable goods, things that can be expected to last for more than 3 years, things like cars, big appliances, etc. Non-durable consumer goods are goods that are consumed in 3 years or less. So that would be things like food, maybe some clothing, cosmetics, vitamins, things that we're using all the time. And then consumer expenditures for services are also included. The next category of spending is gross private domestic investment. This will be abbreviated IG. This refers to all purchases of capital by businesses. So that would be things like man-made tools and machinery that are used to make other products. So if a landscaping company purchases a new Z-Term lawnmower, if a business upgrades their computer system, all of those things would be included in gross private domestic investment. We also include all construction because any building that's constructed could be used as a source of income. If it's a residential home, it can be rented out and income earned that way. If it's a commercial building, it can also be leased out to other businesses and create income for its owner. So that's why construction is included in IG. The other item on there are changes in inventory. So businesses always have inventories on their inventory on their shelves throughout the year. They measure how much they've got at the beginning of the year, and then they measure it again at the end. If the inventories have gone up, that's a number that's figured in. If the inventories have gone down, we figure that in as well. The last 2 categories are government purchases and net exports. Government purchases include government expenditures for goods and services, things like roads, schools, military funding, as well as ships, planes, artillery, things like that you would use in the military. It also includes expenditures for publicly owned capital, so that would be like vehicles that are owned by the federal government or school buildings that are built and owned by state or local governments. The one thing that's important to remember is that our government spends a lot of money. However, its number one expenditure is transfer payments. These are cash benefits that go from tax revenue into the hands of qualified citizens of the country. So things like welfare, Social Security, Medicare, Medicaid, food stamps, Section 8 housing benefits. These are all things that entail a cash transfer from the government to an individual. They are the number one expenditure of our government, but they are not included in GDP because they essentially just involve moving money around, not actually generating economic output. The last category is net exports. And in order to get this number, you have to take the value of your exports and subtract from it the value of your imports. So when we put all of these things together, the equation we're going to use is C plus IG plus G plus XN equals our GDP. One last thing to keep in mind is that all financial transactions are excluded. So again, just like transfer payments, if we're moving money from one account to another, whether it's from the government to an individual or from one stock to another, or from the sale of a stock to the bank account of a seller, any of those transactions just involve moving money, not generating new money. So they are not included at all in the GDP. All right, so let me talk about a few of the shortcomings of GDP. So GDP can tell us a lot of things. It can tell us how big the economy is. It can tell us what kinds of things that the government spends its money on, what kinds of things that other parts of the economy spend their money on. But there's a lot of things it doesn't tell us. For example, it does not capture non-market activities. So if you have a skill and you provide it to yourself or someone else at no charge, say you know how to maybe fix an engine on a car, that's something that you could earn money for. But if you're not collecting payment on it, you're providing a service that has a monetary value, but we're not capturing that in the GDP. Those are examples of non-market activities. You also have leisure time. Maybe GDP numbers are really high for a particular country, so it appears to be very wealthy, but that doesn't tell us anything about the quality of life and as far as leisure time goes for the people that live there. GDP also doesn't tell us about improved product quality. We can't measure that just by looking at a dollar number. We've also got the underground economy. So we've got black market activities like the drug trade that take place. They definitely generate economic activity, but we're not capturing it in the GDP. There are also costs of economic growth. For example, if there's environmental harm, that wouldn't be calculated within the GDP. Distribution of output, so like distribution of wealth and income, is not counted in the GDP. And of course, there are lots of non-economic sources of well-being that are not counted within GDP. So GDP isn't all-encompassing. It's just one way to see how we're spending our money, where we're spending our money, and where all of these resources go within the economy.